You recently wrote a piece where you talked about the difference between ownership and debt and said that was really critical to understanding investing. What do you mean by that, and why do you say that?
Well, people talk about the many ways there are to invest: stocks, bonds, real estate, private equity. I've named a
derivatives
bunch of them.
You mentioned
yes,
as well, right?
Derivatives, currencies, commodities. But really, if you want to think in an organized fashion, I think you should think about ownership and lending. If you want to invest in a business, let's say your brother-in-law says, I'm going to open a restaurant, and I'd like some support. You have two choices. You can say, okay, I'd like to be a partner, I'll take half. I'll put up half the money, I get half the profits. I don't know how you'll do, but I'm going to back you. Or you can say, I'm not that confident it'll be great. I'll lend you some money, but I want you to promise me that you'll pay me interest every 6 months and give me my money back at the end of the term. And I get paid before you get paid. So my relationship with you is contractual and senior. So that's the difference between stocks and bonds. A stock is a partial ownership of a business with no promise of anything other than your share of what all the owners get, if there is something. A bond is a promise of interest and repayment of principal in a priority basis. And for the most part, ownership assets give portfolios their dynamism and their upside potential, but at the cost of being uncertain and having significant downside potential. Lending assets have a fixed promise which is dependable but limited in its upside.
I remember once hearing you say, Howard, there's no bad assets, only bad prices. What do you mean by that?
Well, look, I started work in this business 55 years ago last month, and at a bank, and the banks invested in what were called the Ni프티피프티, the stocks of the 50 best and fastest growing companies in America. Companies that were so great there was no price too high. Nothing could ever go wrong. And if you bought the stocks the day I got there and held them tenaciously for 5 years, you lost over 90% of your money. Why? Because they were too expensive. It's not what you buy, it's what you pay that determines a good investment. Now, the longer your time horizon, the quality of the thing you buy matters more, and the price you paid matters a little less. But still, people have to understand that good asset is not synonymous with good investment. To make a good investment, you have to be price conscious. It's not a matter of buying good things, but buying things well. And you have to understand that difference, and it's more than grammatical.
All right, that leads me to ask you what you think of the equity markets right now. I know you're not necessarily a big equity person, but are we in a new Nifty 50 era with, say, the Mag 7? What is your thinking about equities?
The easy answer is to say we are, not necessarily correct. You can't make any meaningful observation about assets unless you know them extremely well, and I don't. First of all, Oaktree generally doesn't operate in the stock market, being alternative managers. And secondly, I am not tech savvy, growth savvy. You know, it's just not my thing. So I don't want to mislead anybody. These are prices which on the numbers look expensive. We gauge that by looking at the price-earnings ratio. They have high price-earnings ratios. But, sometimes a high-priced car is worth it and a low-priced car isn't worth it. So low prices and cheapness are not synonymous. I think everybody thinks these are great companies. They may be great companies. They have high PE ratios. They may be deserved.
Why do you think we're going to be in a higher rate environment, though, Howard?
I think we're going to be in a normal rate environment, and that period wasn't normal. That period, as I said, fighting the global financial crisis and fighting the pandemic through monetary policy was very important. It was well called for and well delivered. And it worked. We're still here. After the Lehman bankruptcy in 2008, people were talking about the meltdown of the financial system. Didn't happen, thanks in large part to the Treasury and the Fed. But the emergency is over. The emergency rates of zero are no longer called for, in my opinion. And when rates are extreme, they skew the financial markets. When rates are too low, they subsidize asset owners and borrowers, and they penalize savers and people living on fixed income and lenders. And I think the authorities, the Fed, the Treasury, should not be in the business of doing that. They should let interest rates occur naturally through negotiation between borrower and lender. And I don't think when the lender and the borrower sit down to negotiate, they're going to agree on 0.5% or 0.
I want to ask you about the business, private equity, private credit in particular a little bit. You were one of the pioneers there, but a lot of people have been rushing into this business. Are you concerned there's too much capital there, maybe even a bubble?
Well, I don't think it's a bubble. A bubble is a certain word which has come into broad use, I would say, in the last 20 years. I mean, it's always been around, but it's been popular, especially in the media, in the last 20 years. And a bubble to me means a psychological state of mind where people have lost their mind and they're excessively euphoric, making silly investments and riding for a fall. I don't think that's what we're talking about here. Most things are elevated today. You asked about the stock market before. The stock market is clearly on the expensive side. We look at the PE ratio, the price-earnings ratio of the S&P. It averaged 16 for the post-war period. Today it's 22, 23. It's a little above average. It's not crazy. In 2000 it was 32. That was crazy. 22 or 23 is not crazy, but it is certainly not cheap. Even when you take out the Magnificent Seven, which are substantial in the index and pull the average up, you're still not. You're still probably in the high teens. Expensive, but not nutty. Most things are expensive today. Why? Because most investors are optimistic. We've gone through a good period. We've beaten the challenge of inflation, apparently without producing a recession, what they call a soft landing. Normally, you fight inflation with tight policies which produce a recession, not necessarily in this case. So things are going well. People are optimistic. They have bid prices up to most things. People are unworried. That usually equates to high prices. So there aren't too many great bargains around. I wouldn't argue that almost any market is kind of, desperate on the bargain counter. But still, there are smart things to do today, but this is not the climate, in my opinion, in which to push out on the risk curve, because we talked before about the importance of buying things well. It's harder today to buy things well if things are a little elevated in price.
And final question, Howard. You have been sharing a lot of your ideas over your career. Why do you do that? Are you afraid, though, of giving away the secret sauce of your success?
Well, first of all, for me, writing the memos which share these things, it's a creative outlet for me. I enjoy doing it. I like to educate. The clients like to get them. And today, the broader audience likes to get them. I'm happy with that. I can tell people about the importance of the things we're discussing. That will not necessarily able them to do the things. So I don't think the oak tree is giving away all of its competitive advantage. And I think that our clients are better clients when we have a relationship which has been built on education and a clear understanding. So I'm happy to do it, and I'm not worried that I'm going to put Oak Tree out of business.